Now, the U.S. Federal Reserve Chair Janet Yellen will face a difficult set of challenges next year, especially when it comes to deciding if and when to raise rates. And if it does happen, it will likely be a gradual process. Daniel Wrenches has more.
The U.S. economy has finally shown signs of a sustained improvement after years of uneven recovery. America's central bank must now decide when to begin raising interest rates in 2015.
The federal funds rate is the main tool for the Fed to adjust the cost of borrowing dollars. It's been held at near zero for 6 years in order to encourage economic activity. With a recovery, you would normally expect rising inflation, but that's not happened yet, mainly because wages haven't risen much and energy prices have come down a lot.
Even as they have this situation with inflation being too low, the real economy is doing very well. Every single meeting when Janet Yellen and her colleagues sit down around that table in downtown Washington, they're going to have to make that decision. What do we weight more? The fact that the economy is doing well, or the fact that, gosh, that inflation rate seems to be stuck at too low a level?
Economists generally think sustained low inflation can suppress economic growth. But Janet Yellen predicts inflation will begin to pick up as momentum builds in jobs, wages, consumer and business activity.
Inflation has continued to run below the committee's 2% objective, and the recent sizable declines in oil prices will likely hold down overall inflation in the near term. But as the effects of these oil price declines and other transitory factors dissipate, and as resource utilization continues to rise, the committee expects inflation to move gradually back toward its objective.
Yellen says the Federal Open Market Committee will be patient about raising interest rates. The consensus forecast is for the first move to be made later in the year.
As long as we continue to see solid labor market data, it's pretty likely that you're going to see a Fed increase third or fourth quarter of 2015. It would take some pretty significant negative surprises to push that off. Similarly speaking, we'd have to see sudden strong increases in inflation, particularly wage inflation, before you got any talk of moving it earlier.
The Federal Reserve holds more than $4.5 trillion in Treasury bonds and mortgage-backed securities purchased during 3 rounds of buying assets known as quantitative easing. The Fed has indicated it won't suddenly sell these assets in order to maintain downward pressure on borrowing costs. Overall, the chair here at the Federal Reserve has shown little desire for any fast interest rate rises even after the first rise begins. Janet Yellen wants to avoid any sharp or unexpected move in 2015 in order not to upset the recovery. Daniel Wrenches, CCTV, Washington.